It's time now to welcome our market master for the day, Dhiraj Agarwal, Director Institutional Sales of Standard Chartered Securities. Dhiraj, even as we welcome you, let me just update you and the world on the markets. We didn't start so badly. It did look like we may at the most give up 0.1% or 0.2%. But after that 5 minutes of bravery, the markets have simply given off. It's almost 1% lower. Okay, 0.9% lower on the Sensex and the Nifty. The Nifty is below the 8,300 mark, 8287 as I speak with you. And a 250 point knock on the Sensex. And that's 27,500 and some change. That's a fairly sharp cut that came in, and the mid-caps, if anything, have underperformed even more. There is a 1.2% cut, and big cuts coming in hitherto respected stocks like Havells down 6%, PFC down 4%, Relcom down 3.5%, HTIL 3.5%, REC 3.5%, three-quarter down, Bharat Forge down over 3%, 3.6% as I speak. Tata Motors DVR has taken a knock, Crompton Greaves 2.5%. These are all favoured mid-caps that are seeing a decent amount of profit taking. Bharti Infratel is and Berger Paints are some of the mid-caps that are standing out, as is HPCL and TVS Motors. But within the index itself, you can hardly see any green stocks. Barely a handful, 3 or 4 stocks. Otherwise, the Sensex and the Nifty are a sea of red. The advanced declines, 3 stocks declining for 1 stock advancing. We should pull up the advanced declines. They didn't start so badly, actually. The number of green stocks were ahead of the number of red stocks, but now it is a 3:1 ratio in favor of declining stocks. So markets suddenly in a spirit of profit taking. Dhiraj, what's your take on the amount of correction we can see? Are we going to see a fairly deep correction? Are you getting some negative cues from the global markets?
I mean, there is certainly some level of increased volatility in the global markets, both from the West and China, last few days, which is causing a little bit of a choppiness here as well. But I have a sense we have gotten so used to low volatility in India that a 300-point cut from the high sounds large, which is just 3.5%, 4%. I don't think it's unusual. I don't think it's large yet. I don't think something like this has not happened many times in this rally. In fact, this rally has got unusual characteristic of not having a double-digit correction right from, I think, last August to last September. So within 13, 14 months, we haven't seen a double-digit correction, which has never happened in the history of markets, not even in 2003, 2007 bull run.
Dhiraj, hi, morning. It is precisely this confidence from a lot of experts that makes you a bit nervous. Just when the market is starting to get complacent, do you think we could be headed for a major fall towards the end of the year?
I doubt if we'll get a major fall. Can it go slightly more deeper? Difficult to say, difficult to rule out. But, I mean, if you define major as more than 10%, I don't think so. If you define 5 or 6% at major, 3.5 has already happened. Another 2% can happen. Tough to say.
What's your currently? What kind of returns are you expecting from this market in 6 months, in 12 months, in 24 months?
24 months is easier to see. 6 months is a lot tougher.
Yes.
So I think 24 months will go to the extent of saying market could be 30-40% higher as compared to the current level. Next 6 months, I think, can be fairly challenging. It could be chopping up and down. There will be tons and tons of events packed up in the next 6 months. We'll have the unit budget. We'll have the speculation around whether RBI cuts rate or not, or delays it once more. Whether the inflation data picks up after the base effect wears off end of December, January. What does the US do to the interest rates? Many people think they will probably advance the calendar for the hike to end of first quarter, beginning second quarter. So first half of next year can be a little choppy. So a longer term, I think it's easier to say. I'm quite bullish longer term.
So to brace yourselves and to prepare yourself for this 30 to 40% run in the next 12 to 24 months, what kind of stocks or sectors would you lap up on now?
You have to be positive. You have to be taking a positive call on the economy. So I mean that from the next 24 months point of view, I think given everything the government is doing, either sorting out the coal supply issue or going in for faster execution, faster implementation, faster approvals, all of those things will unlock some of the latent suppressed GDP growth at this point. I think that should be enough to take GDP growth to 6 to 7% range, which basically means a lot of pressure which has been there on sectors and stocks because of declining economic growth tends to reverse slightly. So it will be largely economy sensitives and cyclicals from 24 months point of view.
Dhiraj, we have been meeting a bunch of corporates either in connection with our 15-year celebration or for various other reasons. The mood is fairly somber, especially in the smokestack stocks. There are metal majors who tell us that absolutely nothing has moved on the mining space, and they get footballed between the central government and the state governments. Even where the Supreme Court has allowed iron ore mining, they have not gotten any positive response from the state governments in particular. As well, power companies are not sounding any more optimistic. They are deeply worried about the finances of the discoms. After the first round of price hikes, tariff hikes have not been announced by the discoms. Their ability to buy power, even assuming coal was available and power is being generated, is extremely questionable. The despondency among the smokestack companies, infrastructure, metals, industrials, is not funny. Are you really confident of growth?
It's always darkest before dawn. So I know what you're saying. The on the ground feedback is that the economy has not recovered at all. Things have not started moving. In fact, if at all, many people actually think that things are a little tougher today than they were 6 months ago. But a lot of things are happening behind the scenes. When on the mining front, for example, the new changes proposed by the government on the Mining Act, that could free up a lot of the bottlenecks that you just mentioned. Similarly, a lot of movement which is happening, that the government is trying to do behind the scenes on coal, should ease out the issue on power. And all the statements which the power minister and the new railway minister has come up with on how they want to promote investment in the sector and free up and get more private participation. All this will happen, but none of this happens overnight. These things take time, which is another possible factor. While to say that next 6 months could be a bit tough and challenging, but longer term, I think work is happening. But there's always a pipeline effect. So, I mean, if you take the example of the previous BJP government, 98 to 2004 or 99 to 2004, well, the good work started in 99. The real benefit of impact on the economy actually started getting visible only 2002, 2003. So it takes time. It takes time.
All right. One final question then from my end, Dhiraj. We've seen a fall of what, 45% in Brent crude since the start of the year. Would you increase your exposure to either paint companies or oil marketing companies or tire companies in order to, play this move?
I think the stocks have already done very well. Purely from a short-term point of view, the risk is that the crude actually bounces from here rather than tanks further. It's purely a short-term tactical view here. I would be wary and be on the lookout for a bounce in crude at this point of time rather than a further crash.
Okay. This seminal fall in crude and other commodities has obviously diminished the buying power of a whole range of countries. Smaller ones like Venezuela, Nigeria, and bigger ones like Brazil, Russia, and other commodity countries. Are you working down the earnings of several companies so much so that your overall earnings growth also falls at all in the next couple of quarters?
I don't think India is exposed so much to buying power from oil-producing nations that our earnings growth will get impacted significantly. What could be a bigger issue for the market going forward is that some of these countries, especially Middle East, etc., have been suppliers of capital to the country. And if the situation persists for a very long period of time, attracting capital from these destinations might be a bit of a challenge. But I don't think from an earnings growth point of view it matters that much.
Fair point. Actually, from earnings, we also should be logically gaining from the fall in commodity prices. Dhiraj Agarwal, pleasure speaking with you. Thank you very much for giving us a many-sided perspective on the macros and the micros of the market.